A moving average, MA, or an exponential moving average, which is an EMA, is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data over a specified time period by creating a constantly updated average price. So just for the sake of this video, I'm going to use an example for two moving averages, the exponential moving averages, the green being the 50 exponential and the white being the 200 exponential. Two of the most important, I suppose, especially when it comes to cryptocurrencies, of how to chart a trend, whether it's bullish or bearish over time. So like I said in the introduction, a moving average is basically a smoothing out of price action over an average time frame. The fact that these are exponential rather than just your standard moving average basically means that the time frame that they're calculated on is shorter than the standard moving average, meaning that the trend is easier mapped because it moves more frequently to more recent price action. So like I say, this green is the 50 exponential and this white is the 200. So obviously the white taking a longer period of time to tell you which way it's going, and the green an even shorter time. What I'm going to show you now is obviously the green is the 50 exponential. This purple here is just a 50 moving average. And as you can see, there's not a great deal of difference between the two, but there is a difference. So if we can have a look at the way that the chart moves, let's have a look at some of these, and like I say, they're a lagging indicator. It's not something that you would trade on exactly. It's part of letting you know roughly which if it's going to continue to move. Now that I'm going to show you some other things on how to use them, but you can see that the purple here lags as it was continuing to go down, whereas this one moved up. If we caught this on the curve, and like I say, you shouldn't use this as a trading tool on its own, but you can see that the price action moved quite dramatically up at this level here, came up to test it, and at that point we started to find a curve that looked as though the trend was changing, but already by the time we got to the top here, the moving average hadn't picked up on that until it was kind of halfway down and telling you that the trend had changed. And then obviously we would have already known that by price action that we're coming down. This exponential lets us know that we're likely to continue to go down for some time, but again, on their own they're not useless, but they do offer us more than just telling us which direction it's going to go. One of the main ways you can use it is part of an indicator. Alright, so the general rule of thumb, and it's quite easy, I'll just take this one off, it's quite easy to see, is that trending above moving averages, especially these two, is bullish, and trending below them is bearish. Alright, so there are other moving averages that you want to consider using, like the 21 EMA and the 100 simple and exponential, but just for the sake of this video we'll just use these two. There's a number of moving averages that you'd want to use. So let's go back in time, let's have a look at how this one has played out for Bitcoin. Okay, so you can see that we've been, ever since we get above it, we're generally bullish. Okay, when was the last time we were below it for a prolonged period of time? All the way back here. So this is going back quite a long time now, 2014. So we can see how we're below it for quite a prolonged period of time. Let's have a look at when we first crossed above it. Okay, so the crossing above it here was an indication that it was going to go up, and we rallied from it. We broke above a 200 exponential, which again, lots of people will have seen that and traded appropriately for it. We came down to test it as a support, which is usually very common, and what we had here would be a failed rally, meaning that the likelihood of us coming down to test it is quite high, and because we had a lower high here, we could have perhaps probably broken it, and we did, and we broke down beneath it. Next time we broke above it was here. That would have been part of an indication to buy, and breaking above the 200 exponential, again a very bullish sign. And then what we had is we had a cross here. That cross is what people refer to as a golden cross. Okay, when the 50 exponential moving average crosses over a 200 exponential moving average, is generally an extremely bullish sign. So what happened here is when you have the shorter time frame crossing above the longer term time frame, not just for the green 50 and the white 200 that we're looking at here, but across all time frames. So if you had a 100 and a 21, when the 21 crosses over the 100 is a good sign. Where even when the 10 crosses over if we had a 10 exponential or a 9 exponential crossing over a 20 or a 50, they're all good signs for the short term. But the longer term, which is why people like to trade on these two, longer term time frame is this. And so what we had is we had our golden cross. We rallied because of that, most likely because of that. We came down to test and we used it as support, and this is what often happens with moving averages, and this is why they're very common to be used. Okay, so we rallied above it, we came down, we broke beneath it, but we didn't break down beneath here, so we're technically still bullish, even though we're having convergence between the two, which convergence meaning that the moving averages are getting closer together, and if these were to cross beneath each other, it would be the opposite effect of this. It would be extremely bearish. It would be what's known as a death cross. So that looks like it wanted to happen, but then it didn't, because we broke above it again and we held above it and we rode it. We were surfing above this green 50 exponential, and which is always going to be bullish. Constantly above it, came down here, a bit of a dump. That could have been for some other reason, but we dumped beneath it, but we closed above it, which is still good. And again, continue to surf above it, surf above it, and surf above it. So you can see that cross there playing out and staying above not just the 200 exponential, which is bullish in itself, but a higher term time frame, a lower term time frame like the green 50 continues to be bullish, coming down every now and then, coming down to test it. Be more opportunities for people to buy in. We've got a divergence between the two, so the area between these two continuing to spread and get further apart, which is more and more bullish. Coming down to test it would have been a good area to buy, and then rallied all the way up here, technically going what people call, well, what's known as parabolic, and then we had a dump from it. But look at how this dump played out. Came down, the first place to really test it and it tried to hold above this green 50 exponential, so you can see that it's being used as support. And again, this is where things kind of go the other way. We came back down beneath it and we stayed beneath it for a while, causing a bit of a bearish move. Death cross being played out here, and then we stayed beneath it for the vast majority of the time, and now you can see that they've crossed beneath each other. They're diverging away from each other and staying beneath the green 50 exponential, as well as obviously the 200 being a bearish until it couldn't take it anymore and had a big dump. And then of course the opposite happens again. We trade beneath it, we break above it, and we start to get supported above it, which is good, and this is where we are now. So this is the beginning of this last sort of bull run, I suppose, of Bitcoin. So staying above it this would have been your first chance to really think that something was going on, coming down and supporting above it, being supported above it, supported above it. It's always going to be a good sign. So moving averages, do offer indications unto themselves, and not to be used on their own. And I'm going to show you something that I suppose could come into play right now. So this is an up-to-date chart that we're at right now. So let's have a look at something that we could do on top of using a moving average. Okay, so what we need is a trend line. So let's get a trend line in here. Hang on, I'm not really very prepared for this sort of thing. Let's get a little trend line. All right, I'll just make it big for you guys again. So a trend line. So is there any areas in here which seem to be tested as support themselves or resistance? I would say yes, there probably is. This area here being around about 6,600 roughly, and you could go back in time on this and see that actually that area has played out for several years as an area of support and resistance. So that is not exact, but it's rough. Okay, so what we could use now on top of this is looking at how the moving averages are going to play out around these areas. Okay, are they looking bullish or are they looking bearish when we get to touch these areas? What does that mean? So we can look on shorter term time frames themselves, like a 4-hourly chart, but for now we're just going to look at this as itself, and what I'm going to say is 6,600 clearly had been support and resistance roughly for quite a prolonged period of time, going back almost 3 years, and is still an area of interest right now. The way that the moving averages are going to play out at that time when we come up to test these areas would suggest whether we're going to break up or break down, if it's a good thing or a bad thing. Okay, so what we would look at here is this golden cross had played out. So if we were looking to make a buy and we were thinking that is it looking to rally or is it going to cool off, we would look at the state of the moving average at the same time as getting to the price action. So the price action of 6,600 at this point was shortly after a golden cross. By the time we'd got to this level here, these two had diverged quite significantly away from each other from a prolonged period of time. You could see that they'd been bearish for a very long time, over a year. This is the first time we'd crossed above it and we got to that price action, which was historically for the previous year been pretty relevant. So it would suggest that here, if we can have divergence between these two, which we got at this price action here, it would be an area to buy. And look what happened. So we rallied from here, we came down to test that support here, but we rallied straight up from it because these moving averages continued to diverge away from each other. Now, what happened this last time is this rally here was absolutely enormous. Okay, so it had to cool off anyway, so it was going to come down. We finally got our death cross here, and the death cross brought us down to all the way back down to that level again. Now, by the time that we double bottomed here, we'd already started to move up, and our moving averages had started to converge to each other at the same time. So if we had broken below this price action here and the divergence had continued, we would have probably come all the way back down to where we'd started, likely. But because we'd already had our first dip here, our second one here, and it didn't break, we started to move up again. So one thing you could also see on this is when we had that golden cross here. I mean, this is very difficult to have charted because we all know what's happened recently. But what I would say is because we had that cross again here, and we broke down beneath it here, what we would be looking for is that 6,600 when we're looking to be above the green 50 exponential. Are we above the green 50 exponential at the time that we hit this? I would have said no, and actually this is where the moving averages needed some other indicators, because this is a lagging time frame. This into itself, until we got to this level here, all this area here would have suggested that we would have come down again, and probably should have come down again. So trading on the exponentials alone isn't the greatest thing at all. But what I would have said is, if looking at this at the time, I did expect us to break back down beneath it because we were diverging away from each other. We were being, I suppose, finding the green 50 as resistance. We were stuck beneath this area. It did look to me like it was going to come down, but it didn't. And in fact, it launched, and you can see what happened when we get above the 200 exponential, using it as support, finding a golden cross, continuing to stay above it. Now, at this moment in time, and like I say, I mean, you can join my channel if you want to look at price action, and we can talk, until the cows come home about that. But the way it's looking right now is that now we had that golden cross, we're getting a bit of a convergence. So they're squeezing into themselves a little bit, and it looks as though, given the price action has just rallied a little bit today, we might be able to stay above it. But this indicator is still going to come down ever so slightly over time. If these two eventually do cross and we stay beneath the green 50 exponential, and you see that they're being used as resistance opposed to support like we've had on this rally here, then it would look like it's probably going to come down again. If we get that cross and it signifies bearish, then it would look like this, and it will continue to come down. And we would use this trend line, as well as other trend lines that you could find, to see where you are at the time. Now, there are other areas of interest for Bitcoin, like 7,700, which had been used around this level here. They're roughly here, and here. So where would we be if the green 50 had crossed beneath and got ourselves a death cross on the daily here, by the time we had sunk a little bit further, you would be looking to test this area and perhaps maybe break it. And that would be a short, really. That's something you'd be looking to do. Now, one thing you can do is you can look at this on other time frames, like 4 hourlies, and you will get the same kind of reads. But because the time of this chart is going to be a 4 hourly, it means that the moving averages move a lot faster and quicker. So what you see here is the same kind of thing play out. You see supports and resistances being played out all the time on these. So we have, you can see here, the green 50 exponential is being tested here as resistance. We broke down beneath it, wanted to get above it, broke, tested, and came down beneath it. Came up above it. It was a bit messy there, and riding it here very neatly. You can see that we're using it all the way up here, breaking above it, coming back down, struggling to stay above it, breaking down beneath it, coming up, riding it, testing it, rallying, coming down to test it, rallying, testing it, breaking down beneath it, coming up, testing it, coming up, testing it. You can see how this moving average and moving averages themselves, even though they are lagging indicators, they are used very frequently, not just on a daily, on a 4 hourly, on an hourly, on a 15-minute chart. We can even go to a 15-minute chart now. You'll see how relevant these are. So the 15, that's not a 15-minute chart. Right, so a 15-minute chart. So again, like I say, this is only a 15-minute chart, okay? 15 minutes, that's all it is. And the same thing plays out on this tiny scale. So you can see here, a cross takes place. We ride up above it, we come down to test it, we get down beneath it, it's bearish, we get a cross, it's definitely bearish from here. We're going to be rejected till further notice. Staying down beneath it, all the way dumped, then finally made ourselves above it. Looks like it wants to make a break. Wait till that break's confirmed, here it is, and then hopefully we can stay above it. Unfortunately, the divergence starts to take place and we dump beneath it. You can see here we're dancing beneath it, break above it, down. So you get more of these technically golden crosses. They don't really count on a 15-minute chart, but what they do try to signify is, and again, they're lagging indicators. They're not anything that you would see across here and make a buy, because by the time we've done that, the price action's already been had. You use other indicators alongside these to make the moves. But you can see how there are relevance between them all. Now the 4 hourly chart does have a bit more of an accurate read when it comes to golden crosses and death crosses. It would be the shortest time frame of a chart read that I would use these two to signify a downtrend to be continued, and it doesn't always happen, but it generally does. So we did have a death cross on this occasion just recently. I would expect this to come back down over time, and we had a death cross here. We had a big dip here, we had a golden cross here, we rallied up from it, we had a death cross here, we continued down from it. So you can see that on a 4 hourly there is some significance to these crosses. You know, cross here, down there, cross at this point, that was a failed one. Death cross here, come back down, cross here, failed one. So the way I suppose to look at these would be in the grander scheme of things is on a daily chart is going to give you the most accurate read for the most prolonged period of time. Anyway, that in itself is a moving average, and that's how it works.